So a balanced price range is any portion in price action where we have a distribution of delivery both sides. And for a very simple approach to explaining that, I want you to think about how this price run from place. In this price run, we have an inefficiency right here, where it's just one single candle traversed between the previous candle's high and the next candle's low. That range between those 2 price points here was only distributed to on this single 1-hour candle. That's what we refer to as an inefficiency. What is it inefficient in? It's inefficient in sell side delivery because this is buy side delivery, not liquidity. It's delivery. It means the movement of one point to the next where price is traversed. In this case, it's moved higher. So this is buy side delivery. It's inefficient in sell side because it hasn't moved back over top of this range at all until we got over here, but it left a small little portion right there in deference to that low and that candle's high. Now going lower or to the left, even further, you had this one. I like this one because it's anchored to an order block. Why not this one, ICT? This one here, because we have 1, 2, 3 down closed candles. That's all one order block. It's one single delivery of sell side delivery. Okay, it's not a gap. It's one single block of price action that moved one direction. Its opening is here. That's the change in the state of delivery. That resides very close to the midpoint of this gap here. I'm incorporating this volume imbalance, which is the difference between this candlestick's close and this candlestick's opening. So there's no bodies connecting here. It's just the 2 wicks that are joining and touching. So that's our volume imbalance. This portion of price action being delivered to the upside, leaving the order block, I like that in and of itself because it's a fair value gap that's going to be utilized and more likely to be influential over price action because it has more than just simply one candlestick saying, hi, I'm a fair value gap. It's anchored to some other PD array, which is this order block. So it leaves it here. And this portion on the upside, that single 1-hour candle going up, it's overlapped with this portion of this single 1-hour candle. So the open here, that's the high of the buy side imbalance, sell side inefficiency. It's not a suspension block because there has to be a volume imbalance to the lower end too, not just one side. So this is a buy side imbalance, sell side inefficiency. This candlestick's high is the low of this BISI, B-I-S-I. Buy side imbalance, it means it's one directional. No other candle shares this range at all until we get to this candlestick right there. And notice what it's done. One single pass here, and then one single pass here. So that makes this portion of price action right in here a balanced price range. What does that mean? Well, it means that if price can trade up to it, it's going to be a formidable foe in terms of allowing price to cleanly cut through that. It doesn't mean it can't, because if there's a geopolitical event that takes place, something that was unexpected, then obviously you can see that there's very little in terms of resistance keeping price from going wherever it wants to go in extremes. But here, it's a wonderful objective to reach from the upside because how far could it traverse into this portion here? Well, you can grade this high to this balanced price range low, and you can get quadrants there, and you can see how it eats into that. And all I'm doing is showing you how to grade an inefficiency between 2 PD arrays. There are so many things that you can study and ferret out of price action when you understand how price is actually booked and what liquidity and inefficiencies mean in terms of price. Everybody sees these little inefficiencies and say, oh yeah, look at that. It's going to come back and overlap that area. Okay, well, that's not enough. I want to know, when is it likely not to do that? When is it likely to only trade to the lowest portion of it and then sell off? When is it likely to go to half of it and stop and turn on a dime and then go lower? Or when is it going to overlap it entirely, overtake it, and then use it as a trampoline, as a discount array that sends price higher? So this range here, from here, that I'm not anchoring to this candlestick because it's the candlestick's time. It's the range. The high of that candlestick is what we're framing for this portion of price action. It's balanced price range. But we can see how price dug into the lower quadrant of that range and failed to get to the middle or consequent encroachment. So until we get a close above this, The range is defined by what we have here in the opening range. So this is the initial short-term high during opening range. We're entering the macro right now. So it's 9:50 a.m. And we'll see what we see in terms of price action. But now we have a marker that delineates if it can take out this high and close above this halfway point that's being highlighted here at 24,736, then we would be bullish. And I would only be bullish up to this candlestick's low in the lower quadrant. Halfway point, I wouldn't be interested in, and only just for day purposes. So in other words, like PM session, lunch macro, all those types of things, final hour trading. This is the furthest I would expect for today. Not that it can't go higher. If it did, it would just move without me. So that way, kind of explains my perspective there. So that's the business here. We're going to drop down into the 1-minute chart. So this is the new week opening gap range that's highlighted here with the gradient levels. And then we're going to do the same thing with range gap. So we have the opening here, previous settlement. So here's midpoint. So there's usually about a 70% chance that that usually can be traded to. So half the gap by 10 o'clock. Having a gap in the morning between 9:30 open and where we settled the previous day is a wonderful opportunity to study that premise. There's a rhyme and reason why price does certain things, but simply me saying it isn't enough. You have to be able to look at it yourself, measure the importance because you've seen it happen this many times out of this many observations and drills looking for it. All right, so this right here, 931, that's the minimum criteria for a first presented fair value gap. So you have to see that 931 candlestick open up and close. Once that forms, if it has a fair value gap, which in this case it does, this is the earliest you can use. And honestly, if you only stick with 931 as your earliest potential first presented fair value gap, it will yield so much more clarity and remove a lot of the uncertainty and ambiguity also when watching price action. You'll just know I can trust this because these points of reference hold up more time than they fail. That's, I guess it's the easiest way of saying it. So we have a minor buy side here. We already, like I said, we ran above higher straight from the opening bell. First presented fair value gap is here. And you have a volume imbalance at the high end of it. So we have sell side here, day session. That means electronic trading hours. We have sell side formed here, and we have buy side here. They would be considered minor buy side, minor sell side, because it's just simply the first range that was formed inside of the first 30 minutes. And by having that reference point, what you'll be able to determine is which one does it run for next? What's the benefit of that? It helps you trade the silver bullet that forms in the 10 o'clock hour. So if we run up and take this out here, then what we would want to do is see it stay running towards that balanced price range I showed you on the hourly chart. If it were to go above this high here and falter and break lower, then chances are they're going to probably run for the sell side. And if it's going to do that, then we have to consider the upper quadrant consequent encroachment for the opening range gap. So it's a if then clause for like an algorithm. If price can do this, then I'm going to focus on that. While it's in the middle like this, do nothing. Don't do anything because it's already given you a run here that was profitable. Minor buy side over here, and that level here I had already on the chart, and I told you that's where it's likely to go to. And it cleared those. And it's fallen short of that dynamic range measuring that inefficiency between the hourly balance price range and the low shown on that hourly chart. And when I did that grading, that's what that says here. Okay, so I'm annotating this here as the midpoint. So as long as we're below this, it's likely that we'll run for the sell side and maybe try to work in towards the consequent encroachment or midpoint of the gap that was the opening range gap. Trading above that, then the low of the balance price range on the hourly chart. So we have first presented fair value gap. It trades down into that. Minor buy side isn't It's in striking distance, and that halfway measurement of consequent encroachment on that dynamic range on the hourly chart, it's just above that here. So that would be a deciding factor. If we can take out that high, how do we use this level? Does it trade above it and close above it? If it does, then it warrants a continuation. In my opinion, it's my opinion only, that it would reach for the balanced price range to the upside. Okay. If it trades above this and fails to go here, or it trades above it and wicks through it and then closes back below this candlestick's close, which would be what? The rejection block. Then it would be more likely that it would reach back down into the run the stops here, and then the opening range gap becomes a primary concern. But right now, sticking with the strength of opening up in the direction of the opening range gap, that means where we stopped trading Friday here and where we opened today. That's what the difference is, okay? That's our opening range gap. So this is the high of that candle, and that's the low of that inefficiency or dynamic range. This portion of the drop down, how much can it trade up into, is defined by this candlestick and that candlestick. And I talked about the reasons why, because this is the buy side delivery and this is the sell side delivery that makes up this balanced price range. So think of this like the firmest boundary on the upside that I would see for the morning session. And I would be content if it could trade there. And I wouldn't have any desire to demand that it gives me more than that. So again, here is the science behind what you don't see in textbooks and nobody else talks about these types of things. It provides you a great deal of clarity. It gives you a lot of focus on what is possible and why price should act this way. And it's algorithmic. You can see how it's delivered. We used this new week opening gap initially, how we traded down into that there. Whenever you get a new week opening gap and it trades down and closes it ahead of the morning session, as we see here, it's Monday, November 24th, and that formed at 5 a.m. this morning. So that's 2 hours before our early pre-market session, which is 7 o'clock in the morning to 10 o'clock. And that is the encapsulation of both Forex and futures trading. So the retracement down into that new week opening gap here, where we settled on Friday and where we opened, it trades down to 3/4 of that and then rallies. It's a 3/4 mark there. See that? And we traded up, ran in the direction I gave you at the start of the stream, drove into the level I told you, and now we're underneath the condition of, do we close above this? Okay, do we close above it? On the 1-minute chart, you can see we laid down a couple bodies. We closed above it here. We closed here. And now there's a volume imbalance with the fair value gap there and an old high that has a wick. So what we would do with something like that is you want to measure the wick. All right, so we would want to see the body stay in the upper portion of this wick if it remains bullish, okay? It could be done for the morning session and then a deep retracement going into the 10 o'clock hour, and that might be the criteria that's used for silver bullet. But here, to see a sustained run up into the balanced price range, which is up here, I would want to see the body stay in the upper half in this blue line here. Like, see, this is permissible, that little drop down here, but I would want to see the body stay up here and then start to resume going higher. Otherwise, we would already have a scaling of partial profits here, limit orders resting here, and then something right above, right, I'm sorry, not above, but right below that, okay? So you saw today, I came out live right out the gate, told you directional bias, the narrative as to why it would be utilizing that. It traded to 2 targets. This one here was the first one, minor buy side. Then we have the level here from the hourly chart, and then we had this minor buy side trade too, and then the consequent encroachment of that dynamic range on the hourly chart. So there's 4 targets right there. So it's filled 4 numbers. So you would only have about 20% of your original position on that you went long on right out the gate, trading in here, because it already gave you an optimal trade entry long there. So it's already showing a willingness to lay a body down below here. So it would need to immediately reject that and go higher, or we're probably going to roll over and start trading right back down into this portion of this consolidation. And then what you would do then is measure the high to that low. Where would the equilibrium price point be in that? Oh, it's just simply taking this. But that's right here is equilibrium of this range. So the last line in the sand for morning session bullishness would be this line here. So halfway of all this consolidation, which isn't all that big of a deal because it's really just a 1 minute consolidation, it needs to stay above that. So in other words, it's okay if it trades all the way down there, but if it repels back above it, then we would want to consider, again, all the things I mentioned up here. Otherwise, if we lose this level here on a closing basis, my morning session bullishness is now pushed to the sidelines. I would be done. Meaning what? My stop loss on the position that would be long down here would be resting just below this. Now, see how that's easy? It's easy, isn't it? So now think about it like this. We've had a run right out of the gate here at 9:30. So there's 9:30. We have first price to fair value gap. We've had 4 levels filled. We have sell side resting here. And that was the run that took us to this level there. If we lose the middle of this consolidation, in other words, look at it like this block of price action right there. So this consolidation and price action, halfway is right here. That's equilibrium. So if you ever study how price moves from trending or price swing higher, then it moves into a period of consolidation like this, which is how I was teaching the elements to a trade setup. If you study that, I talk about how there's retracements, expansion, consolidation, that type of stuff. This is where markets are in consolidation, and then they have an expansion run. Now, if it's going to trade back down into this consolidation, we want to see it stop at the midpoint. Consolidations, when bullish, only trade down if it can even manage to get down to halfway. That's usually the halfway point sensitivity, and then it resumes going in the direction it wants to go on a higher time frame basis. So having this understanding of consolidations when bullish are very sensitive in the upper quadrant or upper half, just like I teach with the PD arrays. The same application I use with individual PD arrays is what you want to use at consolidations. So what are we doing? It's the same school of thought with market structure. We have a small little gap in here, and price traded down into upper quadrant of this consolidation, and look at the sensitivity there. The bodies, wick down, yes, fair value gap, and in this wick. Traded right back up to the old high, which was what? What is this level here? That's that consequent encroachment of the dynamic range I gave you on the hourly chart. That was between the balanced price range low and the other level I anchored to on the hourly chart. You can see here, the market's reaching up another scale of minor buy side here. So we had a minor buy side here, they traded to that, and they left this high, and we're real close to it. So you have to watch and measure, does it want to close above this high? And if it does, it needs to reach and close above that quadrant. This quadrant is anchored to that hourly dynamic range below the balance price range and the low point I gave you when we were on the hourly chart. And you're not focusing too much on like this level here. It's already used it. This here, it's already used it. Now we're in exploration and we're seeing, is this going to be accepted by the marketplace? Is the algo going to stop here because we printed above it? We didn't even get down to the equilibrium price point, and we created a rotation higher, used it, run here, ran to another higher high. So that, and again, what would you consider that in terms of bullish or bearishness? Would you consider that bullish? Of course it's considered bullish. Why? Because we couldn't even get down to the midpoint or equilibrium of this consolidation. So far, we did not print at that upper quadrant from the hourly dynamic range. And what these are, okay, think of this perspective much like I showed you when we were looking at the analogy of a rock climber. When you're trying to go up in price action, it's very easy to use the old reference points in the market that went lower to the left. All you're doing is looking for all those PD arrays, and it's not classic support and resistance. They're very specific elements in price action at very specific times. So by having them, you can anticipate where the footholds are going to be at in advance. And then also by putting mile markers, which is all these quadrant levels are. There is nothing more than just simply an opportunity to measure, does the PD rate exist in form at that time when it trades there, at the time and at that level, what the quadrant level is, and how does it trade to it? Does it trade to it and through it and close above it? Like we're anticipating, we wanted to see it close above that midpoint here, which is on the hourly chart. So when it did that, we knew it's still bullish. Then we did what? We went to this consolidation and said the last line in the sand for morning session bullishness, it couldn't even get down to that. So that's bullish. Another run here, rallies. We took this buy side out here. We're above this quadrant. We want to see this candlestick close above this. Okay, we want to see that close above it. If it does that, everything remains the same. It doesn't mean it can't collapse and trade lower. We just got it there. So now my stop loss, if I was still long, remember we were talking about how the stop will be below here? Now, because we're so long in the tooth with this trade, I don't want to see it come back down, and it would be just right below here. If I got stopped out there on the remaining 20% of the original position I went long on in the 930, 931 candlestick, I would be content and I wouldn't feel bad about it, even if it went and ran up into that balance price range on the hourly chart. I'm giving you parameters that it should not breach this level. And as long as it does not, then we are looking for higher prices. What's the next threshold? What's the next upside objective? What's the next handhold for price action? If you're climbing higher on that rock surface, your rock climber analogy, you have to know what you're reaching for next. Well, we're at the only one right before the target that I had this morning. And I don't care if this thing trades to 25,000 today. I don't care. You have to know what you're willing to take and be content with and move to the sidelines and be done. So anyway, now I would chase the stop loss right up underneath that low right there and strangle the trade. I would not let it turn on me. This is chasing and running down equity. I'm not allowing it to come back down and run back over top of this leg here. So the stop will be right below there. So it either runs in my favor or stops me out and I'm content. And then I can go to the grocery store and get the cranberry sauce so that way my daughter-in-law can eat her ridiculously nasty stuff.